Welcome to the 3-Edge Week in Review for the week of February 24th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here, once again today, is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. There's an expression in investing that I think is important, and it says, don't confuse the stock market with the economy. And it simply means that the performance of the stock market may not always reflect the overall health or performance of the economy. The stock market can be influenced by a variety of factors, investor sentiment, short-term trends, and those may not necessarily be indicative of the condition of the economy. And I bring this up because today Steve and I are going to discuss the most recent report from the University of Michigan, which showed that consumer sentiment in February had dropped by almost 10% from the prior month of January. And that's the largest month-over-month decline in consumer sentiment since 2021. And it's driven, not surprisingly, by worries of a potential resurgence in inflation from President Trump's impending tariffs and the potential for trade wars. The survey also showed consumers expect an inflation rate of 4.3% over the next 12 months, and more than half the consumers in the survey expect the unemployment rate to increase. So it is only 1 month of data. It was a fairly negative report. And now there needs to be some disclaimer here, because when you look at consumer sentiment index, it can be driven by party affiliation. But still, 10% decline in 1 month is significant. But meanwhile, also in February, the S&P reached yet another all-time high, even as President Trump signals his intention to place 25% tariffs on goods imported from the EU, and preparations continue for 25% tariffs on Mexico and Canada, beginning as soon as next week. And then this past week, the president announced his intention to impose additional 10% tariff on China. However, despite all of that impending tariff talk, in the first 2 months of the year, investors put approximately $150 billion into U.S.-listed exchange-traded funds, which according to Bloomberg was the best start to a year in terms of flows into U.S. ETFs ever. So today, Steve and I will discuss this apparent divergence between consumer confidence on the one hand and investor sentiment on the other, why they may not be in agreement, and whether they can converge in the months ahead. And perhaps we're seeing an early warning sign of negative consumer confidence spilling into investor sentiment. So over the past 7 days, the S&P, which had reached an all-time high in mid-February, the S&P and the NASDAQ have both given back the lion's share of the gains that they had generated so far in 2025. So let's get started. So Steve, as I mentioned, we often talk about this idea, this concept of not confusing the market and the economy. And at least up until the middle of the month, it appeared consumer outlook for the economy had turned decidedly negative, while investors' outlook, perhaps for U.S. equities, remained fairly ebullient, at least until the last 7 trading days. So to start off, perhaps you could explain why consumer and investors could have different views on the economy and the stock market.
Well, a couple of things come into mind, Fritz. One is that there are times when the economy is going one direction, the stock market is going another. People are scratching their heads saying this makes no sense, but it actually does, because the stock market is trying to look ahead several months or a year or more and anticipate what's going to happen, where the economy is what's happening in real time. And so I can think of examples in the past where the economy was doing terribly, but the stock market's taking off, and people wonder, what's going on? And it's because investors in the stock market see that there are signs of new stimulus coming in. They know the stimulus won't help the economy for several months, but they're anticipating eventually news will be good and the stock market takes off in advance of the economy. Or conversely, the stock market, despite a really healthy economy, starts to go down, and people say, well, what's happening with the stock market? And the stock market is anticipating a recession maybe 6 to 9 months or more into the future. And the economy is still strong because the recession hadn't hit yet. And so we see that a lot too. And there's a famous saying that the stock market often anticipates 9 out of every 5 recessions, because sometimes it over-anticipates and then the economy self-corrects. There's another factor going on here, though, and that has to do, and you hinted at it, that has to do with psychology. And right now, consumers are thinking about the goods they buy every day, the groceries, automobiles, TVs, et cetera, and they're very worried that the tariffs are going to make prices go up. At the same time, they see all these headlines about layoffs and job cuts and how there could be a contagion from the government to private enterprise. And so there's a lot of worry about, well, now maybe the economy is going to slow down, we're going to have rising unemployment. Very differently in the market, you've got a different demographic group who has been conditioned for a long time now during this major market rally to always buy the dips on every correction, to ride the trend, to follow the trend, fear of missing out of more gains. So you've got this very strong positive psychology that's persisted for a long period of time, driving the markets higher and higher. So it is true that while obviously the stock market has a relationship with the economy, they're really under different time frames and under some different forces.
All right, excellent. All right, so let's dig into this a little bit more, this divergence between the consumer and the investor. And perhaps most importantly, whether the recent declines in U.S. equity markets, is that signaling that we've reached the point where a negative consumer sentiment may now show up in the stock market?
So what's possible is that negative consumer sentiment can be self-reinforcing and self-fulfilling. So if consumers are convinced inflation is going to go up, they can behave in ways that actually helps cause inflation to go up. If they're convinced that the economy is going to weaken, they can behave in ways to reduce spending and increase saving to actually help cause the economy not to do well. So you could argue that just in the last few days, where the market's given up much of its gains, as you mentioned, the market could be sniffing out the next recession that still might be a few months away because it's still a strong economy, but it could be sniffing out the next correction. Alternatively, it's always a big question mark whether the tariffs will actually get implemented as being announced and very soon, or will it be a big bluff and will there be an extension? And I think generally speaking, the consumers are more afraid of the downside case there. The investors are more hopeful of the upside case. So there's another dichotomy.
Interesting. Okay, so my final question, as always, based on what we've discussed here today about the consumer confidence versus investor sentiment, how we may be seeing the U.S. equity market begin to reflect the negativity in consumer sentiment index, is there something that investors should consider changing in their allocations at this point based on all of this?
I think that people should be watching very closely that while the optimistic case is that this is just another bump in the road, the market is going to go up forever, buy every dip, don't miss out on the rally. There's still many, many optimists that would feel that way, and time could prove them right for a bit more. But I think we have to take more seriously the threat of stagflation. Now, we haven't had stagflation in 50 years. A lot of people don't know what it's like to live through stagflation. A lot of investment managers out there hadn't had their careers start long enough back to actually experience what stagflation is. But stagflation is something that needs to be very seriously considered. Stagflation is when inflation goes up and at the same time the economy slows down. It's the worst of all worlds, because when inflation goes up, it's bad for the bond market. When the economy slows down, it's bad for the stock market. And most people only have stocks and bonds. So I would say that because stagflation is a threat, it's not a guarantee, but it's a threat, people should be careful not to have too much of their money tied up in long-term bonds. People should be careful not to have too much of their money tied in risky equity assets. In the hedge that does best under stagflation are TIPS, Treasury Inflation Protected Securities, and gold. And so there should be some element in a portfolio of TIPS and gold that help protect against the potential of stagflation, along with some short duration treasuries.
Yeah, and again, I mean, that's sort of the way we look at the world and why we always have some real assets, some gold and other assets to protect us in those cases. So Thank you very much. Very interesting to see what's going on here. And of course, we all wait now until next week to see the 0 hour for the indicated tariffs on the U.S. trading partners, which could occur as soon as next week or not. So that will do it for Steve and me for this week. Next week, Eric Beagleise and I present our monthly View from the Edge for March. As a reminder, all our videos are always available on our 3 Edge YouTube channel. If you know someone who you think might enjoy them, please feel free to share them. And in addition, if you enjoy watching the videos, find them to be helpful, please consider subscribing to our 3 Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.